Good day, fellow investors. In this video, we are going to discuss the difference between simple investing and complex investing with Seth Klarman. Simple investing is pretty simple, great business at a fair price, as Warren Buffett says. But on the other hand, we have Seth Klarman with bargains, bankruptcies, offerings, rights, complex securities, and everything. But somewhere in the middle, and the most valuable that I could find in these chapters of the margin of safety is catalysts and spin-off. So we have a lot to discuss here, and you will see what can help you as a retail investor and what will make your life easier because you will simply avoid it. Things to avoid like liquidations, complex securities, rights offerings, even risk arbitrage, thrift conversions, okay, that's from the 80s, bankrupt companies, and maybe you have to focus then on spin-offs and then also catalysts that we'll discuss in a moment. As said, Chapter 10, Areas of Opportunities for Value Investors. So let's start immediately with the top of the chapter, Core and Easy Value Investing. And even if I quote Seth Klarman, of course, everyone wants ongoing, profitable, and growing businesses with share prices considerably below conservatively appraised underlying value. And then the simpler the analysis and the steeper the discount, the more obvious the bargain becomes to other investors. However, such great returns, great investments reach compelling levels of undervaluation only infrequently. And we have just recently discussed one of my many mistakes, how I bought Apple in 2016 at a P ratio of 11 and a large cash position, and the mistake was that I sold too early. But that was in 2016. Then we had a great opportunity in 2020. This is a video I made on March 2020. I'm buying stocks these days because prices are lower but value isn't. Further, interest down to zero, probably for longer, makes stocks extremely cheap. And thus, yes, if you wait for those simple investments that Buffett does, he also does complex things. But most of the benefits that he enjoyed comes from the great simple investments, the Apples, the Coca-Cola, the American Express. So that is something you will have to see how it evolves over this video. Let's now immediately start with the catalysts, and that is a key that you have to incorporate in your investing and always look, okay, what is the catalyst for the unlocking of value, or how am I going to get that value from that investment? Because investing is about putting your money for getting more in return, getting more value. Thus, we are looking for a catalyst. And catalysts are events that occur and cause the value to be realized, the value of the investment. And even Druckenmiller says always the key when it comes to investing is what will push the stock higher in the next 12 to 18 months. That's the key question we have to ask ourselves. And when it comes to value investing, you can find catalysts in liquidations, spin-off, buybacks, perhaps dividend increases, asset sales, and there are many things that can lead to returns, and that is exactly the key. You are there to generate profits. Catalysts are there to generate profits, to realize the underlying value or reduce the discount the market is applying to something. Now, how to look at those catalysts? Well, you have something that might happen in the next quarter or 2 quarters. The market is extremely focused on that. But if you think longer term, as Druckenmiller says, 12 to 18 months, then you can really take advantage of the upside from a catalyst that the market isn't simply focused yet because of its myopic vision. So, catalysts, always look for them. Let's dig deeper into the specifics that Seth Klarman explains in his great book. We will focus most on spin-offs because there is where we as retail investors can find value, but there is always something to learn when you discuss Klarman. Now, when it comes to these complex situations, always keep in mind the 1 out of 20 rule, because if you look at cigar butts that have only one left path in them from a value perspective, like corporate liquidations. So only 1 out of 20 that you will look at might be attractive from an investing perspective. As Buffett likes to say, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. So a lot of what Seth Klarman discusses is really ugly, and perhaps the best example of this is the worst investment Warren Buffett has ever made, his biggest mistakes, and that is the old business of textiles, the Berkshire Hathaway. He liquidated over 20 years of ugliness and pain. He didn't make much money of it, but the name remains, and the other businesses have thankfully justified the investment and compounded forward. When it comes to corporate liquidations, you get to a total realization of value, conglomerates, but there are also lawsuits, management interests, and many complex things that are attached to such things. Might not really be for us retail investors. We might leave this to Klarman. Another example are complex securities. Also, 1 out of 20 that you might look at might offer some value. We'll give later the key component of Seth Klarman's approach. But again, complex securities are those with unusual contractual cash flows or other sweeteners. And one of the interesting investments Seth Klarman has done in the past is buying Tesla convertible bonds. That is a complex security, but I think he bought 200 million in bonds because he was short Tesla on the other hand. So that wasn't something smart. Of course, the 200 million in convertible bonds later really benefited from the stock price going up. So he is always hedged, and that's something we as retail investors can't do. Of course, Tesla convertible era ended because they don't need the money. They can finance themselves very easy without that sweetener of giving you a bond, the safety of a bond, and the upside of the equity. Another interesting opportunity is rights offerings, and that is rights to get new shares in the future. That also depends on the price paid and whether in the future the stock price will be higher or lower. But these are all sweeteners in an environment where the corporations issuing those need those sweeteners to attract capital. We have recently seen the SPAC boom and bust, and yes, a lot of SPAC issued common stock and warrants to sweeten the deal for investors, and despite the sweeteners, that didn't really go far from there. But of course, maybe there are some rights offerings now available, but you need to really be a diligent researcher, look into the numbers, the rights, the legal situations there, and that might not be for retail investors because this is too complex, and maybe it's even easier to say, as Warren Buffett does, just focus on the easy, focus on your job, maximizing your income, and invest when an investment is really easy. Further, we have risk arbitrage on takeovers, spin-offs, liquidations, corporate restructuring, and typical example we have discussed in the past, as Twitter is not public anymore, Elon Musk bought it. Those that bought it when Elon was saying he will not buy it got a $22 bonus on their share for a 60-70% return in a few months. So that was a good deal there, but you can never know whether the deal will go through or not. Now, there is something very specific as I read Seth Klarman's chapter there. His margin of safety when it comes to these specific situations is usually the cash on the balance sheet. So all these companies, rights, complex securities, there is always the margin of safety. If Tesla stock doesn't go up, I get the cash back as a bond. So a lot of complex situations, but even with these complex situations, we have to understand the investing cycle. And everything when it comes to investing is part of a cycle. So just a figure, of course, when mergers and acquisitions or spin-offs or whatever, or small caps are in trend, then the price is high And that's the point of maximum financial risk. That might be there for a few years, and then usually there is a contraction and nobody looks at these opportunities. But at that point in time, you might really find opportunities, and when you make money, then everyone else is following that. The best example, if we just take ARK Innovation ETF. So here, very few were concentrated on that innovation. Then suddenly it boomed. And of course, those that invested here paid the highest price, took the highest risk, and unfortunately, there was no reward. But now that nobody wants to invest in these innovations, you might find actually opportunities. And let's look at the sector that might offer opportunities. And I'm going to dig deeper over the next few weeks there. Spinoffs. Also, very cool a few years ago. Now, in the general market environment, there might be some bargains, which is typical value investing, looking where others don't look. And I went to Google, typed in spin-offs, and you can find lists of all spin-offs. And I'm going to do over the next week or two all the spin-offs, look at them, see whether there is hidden value over the last few years, and then I'll make a video about it. If you want to check this list, just type in 2022 spin-offs on Google, and then you will see the list, and maybe you can start looking before me, and then you can compare your findings with my findings. Spin-offs. A spin-off is a distribution of the shares of a subsidiary company to the shareholders of the parent company. For example, AT&T distributed Warner Bros. Discovery, and then all the shareholders there got a new spin-off. Spin-offs, of course, are made because the management wants to get rid of something, of some business that it makes it look bad. In the case of AT&T, there was the debt. And the following situation is where those investors that were holding the stock for a dividend also see this spin-off as a dividend, and therefore they sell quickly because Warner Bros. Discovery doesn't pay a dividend. Of course, we're following the situation in our YouTube portfolio, so you can check that down in the link below. And the situation is that shareholders know little about the new company, institutional constraints, maybe if it doesn't pay a dividend as a fund, you have to sell it. It's not a member of the index, so if an ETF gets it, has to get rid of it. The market sellers know less, there are no analysts following, and better dump something, especially as the price is going down. Another recent spin-off, Embecta, and you can see starting at 43 and now already at 31, and it was also at 25. So it is interesting to check this downhill as those that got the shares sell, and then see whether there is some value. So as said, low or no analyst coverage. And another incentive for the managers is to keep the stock lower so that they can get those option compensation plans on lower stock prices, and then when the stock price reflects the value, they bank a lot of money in their stock options. But to get that, as it is a starting new company, you need to keep the price lower for a year or two. And then also when it comes to data, it's hard to find data on the new company. So a lot to look forward into spin-offs. I'm looking forward into researching, and then I'll share what I have found in a video. I'm always a curious person, a researcher, so that's what I do. Then we have Thrift Conversions, Chapter 11. This was of the 1980s, so there were many going public. No one could follow the situation, and all of them, thus that was an opportunity. Klarman discusses the Jamaica Savings Bank, but then again, it was trading at 50% of book value, and there is where he found the value in this thrift conversions. Chapter 12, just quickly, these are complex situations. Distressed and bankrupt securities. Seth Klarman recently invested in PG&E that due to the fires went bankrupt, but just to show you how difficult it is to do this as a retail investor. So they purchased, yes, 1 billion PG&E, but they also bought 1 billion of legal claims that an insurer held against the utility. So Seth Klarman on one side was long the stock, maybe also the debt, but on the other hand, if the court decided that the claims were higher or lower than the expected, he was also balanced or hedged there, which is again something we cannot do. Plus, it is analytically complex and often illiquid. The reorganization process is tedious and highly uncertain. You have to do painstaking analysis. You practically have to be a lawyer. You have to assess the level of financial distress, who owns the claims, restructuring process, understand it. Of course, value investing, it is opportunity nobody is looking at, but when it comes to retail and value investing, I think we have to cut the line here, say no to these things, and take the catalysts and the spin-offs perhaps from this chapter that fall into what retail investors can do and not really what hedge funds value investors can do. Hope you enjoyed this chapter. Check the playlist. There will be a link in the description below and also here. Next chapter 13, trading, when to buy, when to sell, how to rebalance a portfolio, how to manage a portfolio. I'm sure you will enjoy it. Thanks for watching and I'll see you in the next video.